In this session, we're going to cover depreciation of tangible non-current assets, focusing on the straight-line method, which spreads the cost of an asset evenly over its useful life. Businesses buy assets that help them operate for more than 1 year. Over time, tangible fixed assets wear out, become less efficient, or become outdated. Assets lose value and usefulness over time, so the business is effectively using up part of the asset each year. Depreciation is the systematic allocation of the cost of a tangible non-current asset over its useful life. Examples of tangible fixed assets include machinery, equipment, vehicles, furniture, and also buildings. Straight-line depreciation assumes the asset is used evenly each year, so the depreciation charge is the same amount every year. The calculation works like this. We take the asset cost, subtract the residual value, and then divide by the useful life. Let's quickly break down these terms. Cost includes the purchase price, all costs needed to get the asset ready for use. So it might include delivery, installation, or registration costs, anything necessary to make an asset operational. Residual value is what the business expects to recover at the end. Basically, the estimated amount you could sell it for or dispose of it for when it's no longer useful. Useful life is the number of years the business expects to use the asset to generate benefit. So straight line is simple. It uses same amount of depreciation every year. Depreciation is an expense, and it is shown in the profit and loss statement. In the balance sheet, we show the carrying amount of a tangible asset, which is calculated as cost minus accumulated depreciation equals net book value. Accumulated depreciation is the total depreciation charged on the asset to date. It is shown separately so the original cost of the asset remains visible. As a result, the balance sheet shows the asset at cost, accumulated depreciation as a deduction, and the net book value as the final figure. Now let's do a full straight-line depreciation example from start to finish. A business buys machinery for £10,000. Its residual value is £2,000. That's the estimated amount the business expects to get back at the end of the asset's useful life, for example by selling it or trading it in. The useful life is 4 years, meaning the business expects to use it for 4 years to help generate income. Now we calculate the amount we're going to depreciate. Cost £10,000 minus residual value £2,000. £8,000 is the total cost that will spread over its life. Straight-line annual depreciation means the depreciation is the same every year. So we take the depreciable amount £8,000 and divide by 4 years. We will charge £2,000 depreciation every year. In the balance sheet, we keep the asset's cost visible and record depreciation in a separate account called accumulated depreciation. So the balance sheet presentation is cost minus accumulated depreciation equals net book value, NBV. The original purchase cost stays the same. Accumulated depreciation charged builds up each year. Net book value reduces each year. End of year 1. We charge £2,000 depreciation for the year. Accumulated depreciation is £2,000. Net book value equals £10,000 minus £2,000 depreciation. So the balance sheet would show machinery £10,000, less accumulated depreciation £2,000, net book value £8,000. End of year 2. We charge another £2,000 depreciation. Accumulated depreciation equals £2,000 plus £2,000. Net book value is £10,000 minus £4,000 equals £6,000. End of year 3. We charge another £2,000 depreciation. Accumulated depreciation is £6,000. Net book value is £4,000. End of year 4 is final year. We charge the last £2,000 depreciation. Accumulated depreciation is £8,000. Net book value is £2,000. £2,000 equals the residual value. We don't depreciate below residual value. Residual value is what the business expects to sell for. In our second example, we will be using a delivery van. A delivery van is used daily. It helps business generate income over several years. The van doesn't lose all its value immediately, so we spread its cost over its useful life using straight-line depreciation. The van itself costs £28,800, but there are also £1,200 delivery and registration costs. Now, remember what we said earlier. Any cost necessary to get the asset ready for use must be included in the asset's cost. So we add them together. £28,800 plus £1,200. £30,000 is the figure that appears on the balance sheet, and this is the starting point for depreciation. The van will be worth £6,000 at the end of its life. This is important because the business is not using up that £6,000. It will still exist at the end. So, just like in the first example, we do not depreciate the full cost. Cost of the asset minus residual value equals the amount to be depreciated. £24,000 represents the portion of the van that will be used for calculating depreciation over its useful life. The useful life is 6 years. Because this is straight-line depreciation, we divide evenly. £24,000 divided by 6 years equals £4,000 per year. Every single year, the depreciation charge is the same. Each year, the business records £4,000 depreciation expense in the profit and loss account and reduces profit. Accumulated depreciation builds over time. Each year, we simply add another £4,000. This is why the accumulated depreciation figure grows year by year. The net book value tells us what is the asset worth in the accounts at this point in time. We calculate it as cost minus accumulated depreciation. So we see the value falling steadily from year 1 to year 6. That final figure matches the residual value, which confirms our calculations are correct. On the balance sheet, we always show the asset at original cost, accumulated depreciation separately, and net book value. It allows users of the accounts to see what the asset originally cost, how much value has been used, and how much value remains. So this second example reinforces what we learned earlier. Straight-line depreciation is simple, consistent, and predictable.